Most people don't notice economic shift when they happen. They notice them months later when groceries cost more, when rent jumps again, when their savings feel smaller, and when their paycheck doesn't stretch as far as it used to. By the time people feel the pain, the shift already happened. And right now, we are in one of those moments at the very end of 2025. Something quietly changed behind the scenes that will shape your money, your job, and your investments heading into 2026 and beyond. So on December 1st, 2025, the Federal Reserve officially ended quantitative tightening. That may sound technical, but in simple terms, it means this. The Fed stopped trying to pull money out of the economy and started preparing to put more money back in. And just one day later, on December 2nd, the Fed injected over $13 billion into the financial system in a single move. It was one of the largest one-day liquidity injections since the pandemic era, and it signals something much bigger. Because when central banks change direction, everything downstream changes. Salaries, savings, inflation, asset prices, job markets, and wealth distribution. Most people will ignore this shift and they will pay for it later. A quick history lesson. Why 2020 matters. When the pandemic hit in 2020, the financial system nearly froze. Market crashed, business shut down, unemployment exploded. So the Fed did two extreme things. First, cut interest rates to nearly zero. Second, started quantitative easing, massive money creation. Trillions of dollars were created. That money flowed into stimulus check, business loans, unemployment benefits, financial markets, and the result of all this, the fastest stock market crash in history, followed by the fastest stock market recovery in history. That wasn't magic, that was liquidity. But liquidity has consequences. By 2021 and 2022, inflation surged to levels not seen in decades. So the Fed reversed course. They raised rates aggressively, they stopped printing, they started quantitative tightening, pulling money out of the system. That tightening phase lasted years until December 2025. So why this is a big deal? On December 1st, 2025, the Fed officially ended QT. That alone is significant. But what matters more is what happened next. Within days, billions were injected into the system. Monthly liquidity programs were announced. Wall Street immediately reacted. Because investors understand something most people don't. The direction of money matters more than the amount, and the direction just flipped. So why this time is not like 2020, the AI factor? This is where things get different. In 2020, businesses needed workers, stimulus created jobs. Hiring surged after the shutdowns. In 2026, businesses need efficiency. Efficiency means automation. Automation means AI. Artificial intelligence is advancing faster than the internet, social media, smartphones, blockchain. Companies are replacing tasks not slowly but aggressively. That means something important. We could see rising corporate profit, rising asset prices, but stagnant job growth. This creates a dangerous gap because money printing may boost market while wages fail to keep up. That's not speculation, that's already happening. So what money printing really does to you? Let's talk about your real life. Your savings. If inflation runs at 3% and your savings earns 1%, you are losing purchasing power. Even if your bank balance goes up, that's invisible loss, your salary. If your raise matches inflation, you didn't get richer. You stayed in place while working harder. If your raise is below inflation, you got poorer. This is why so many people feel like they are running faster just to stay in the same spot. Why investors benefit and consumer don't? So there are three roles in the economy: consumers, workers, investors. Everyone is a consumer, most people are workers. Very few are investors. When money enters the system, prices rise, companies earn more, profits flow upward. Workers get wages, owners get equity growth. That's the design. It's not fair, it's not moral, it's structural. That's why investors pay attention to Fed policy. The simplest way to participate is passive investing. Broad market exposure like the S&P 500 gives you ownership in the largest companies in the economy. The strategy is simple. Invest consistently, ignore headlines, let time do the work. This isn't exciting, but it works. Why returns matter more than people think? Small differences in return compound massively. 10% versus 13% doesn't sound dramatic, but over decades it can mean millions of dollars in difference. That's why understanding where money is flowing matters more than guessing the next hot stock. Gold, Bitcoin, and hedging. Gold exists to hedge currency risk. It doesn't innovate, it doesn't produce, it preserves. Bitcoin is different. It's speculative, it's volatile, it's dependent on adoption. Some investors use both, but for different reasons. Gold for stability, Bitcoin for asymmetric upside. Neither replaces productive assets. So where this leaves us heading into 2026, we are entering a period where liquidity is increasing, AI is accelerating, jobs are transforming, wealth gaps may widen. This doesn't guarantee rising markets. Recession can still happen, but it does mean one thing. Ignoring financial literacy is no longer an option. The real decision isn't will the economy be good or bad. The real decision is will you understand the system you live in or react to it emotionally, because the system rewards preparation, it punishes ignorance, and most people won't realize what changed until they are already behind.